Welcome to The Way Forward. I am Chanakya De Silva. Today on our show, we have Dr. Indrajit Kumaraswamy, the Governor of the Central Bank. We will be discussing how this country can be taken on its way forward from the present situation today. Welcome to the show, Doctor.
Thank you. Thank you very much, Chanakya.
My first question will be, can you tell us in layman's terms, what is the base situation of the country's economy is now?
Again, let me thank you, Chanakya, for having me on your show. I think the headline message to give is that the fundamentals of the economy are in reasonable shape. Now, economists, in terms of the external stability of the economy, look at a couple of indicators. One is the deficit in the current account of the balance of payments. Second is the level of reserves of the country. And third is how the exchange rate is behaving. Now, if you look at each of those three, they are in fairly okay shape. Of course, there was a hit due to the events, the very unfortunate and heinous events in April. But because the fundamentals were in pretty good shape going into that period, we have come out of it okay. For instance, I will give you just a few numbers. Now, the current account deficit, which was 3.2% of GDP last year, we were expecting it to come down to 2.3 this year. But then we revised it to 2.8, but after the April events. But as things are improving a little faster than we anticipated, we have now brought it down to 2.6% of GDP. Okay. In an ideal world, it should come down to 2%. But 2.6% is okay. And it has come down from 3.2% of GDP last year. So that indicator is in reasonable shape. Then the official reserves, the gross official reserves of the country, rule of thumb is to have about $6.5 billion of reserves, about 3 months of imports. Okay. At the moment, we are at about $8.4 billion. So that is also above the kind of lower threshold that we try to maintain, and we anticipate finishing the year with about $8 billion. So that's also in a reasonable position. And the currency, which depreciated by 16.4% last year, partly due to factors beyond our control, like the increase in US interest rates, money flew out of our government securities market, the foreign institutional investors who were here because the the interest rate differential between ourselves and the US got compressed, and not only us, a number of countries found money flowing out, and that put pressure on the exchange rate. In addition, we had a couple of pressure points. One is motor vehicle imports, and two is gold imports. Now, we have taken remedial action on both those, and those imports are now at a manageable level, and we've seen the trade account improve. And in fact, the trade deficit in the first half of this year is about $2 billion less than last year. So significant improvement. There's a big improvement. And that is helping us to cushion the losses we are expecting from the tourism sector. Right. We are expecting a hit of roughly somewhere between 1 and 1.3 billion as a result of the events in April. Yes. But that's being, as I said, cushioned by this improvement in the trade account. And so the rupee actually this year has appreciated year to date by about 3.1%. So the current account deficit, the reserves, the rupee are all in reasonable shape. Then if you look at inflation as an indicator of domestic stability, yes, our target is 4 to 6% inflation. In July, it was actually a little below our target. It was 3.3%. It will probably go up a bit, but it was 3.3%. And inflation expectations are well anchored. The inflation outlook is stable. And we don't anticipate inflation going outside our 4 to 6% range for the rest of the year. So inflation also is in reasonable shape. Interest rates have been coming down. The average call money rate, the weighted average call money rate, which is the short-term measure that we kind of influence in terms of money markets, that is near the lower bound of the policy rate corridor. That has also come down. And the treasury bond rates have all come down. The treasury bill rates went up a little bit at the last auction, but they have come down significantly. Where we are a little disappointed is the lending rates. We put a deposit rate cap to reduce the cost of funding for banks, and we expect them to bring lending rates down. Of course, it takes a little bit of time because they have to reprice the existing stock of deposits at a lower rate, then they can pass it on to the customer. So that takes a few months. But now we need to see lending rates come down. And we have told the banks that if we don't see lending rates come down by at least about 200 basis points from where they were in April, we would have to place a lending rate cap on that. So that is something we are pressing banks, because as growth is rather low, we clearly low interest rates are important, and the Monetary Board certainly has taken a number of measures to loosen monetary policy. We're in a kind of we have given forward guidance that the monetary policy will be in a kind of loosening mode. Already we have reduced the statutory reserve requirements of banks. That's the amount of money banks have to deposit in the central bank. We've done that twice, and in November and March, and about 150 billion rupees have been infused into the system on a permanent basis, and we reduced the policy rates by about 50 basis points in May. So we have already given a push by loosening monetary policy, and the forward guidance is that we will consider, the Monetary Board will consider reducing interest rates, the policy rates, even further. Because the conditions, if you look at them, there is an output gap. The potential of the economy is 5% growth. It's growing at 3.1%, we think. So there is that gap. So we can, bring rates down according to that indicator without the economy overheating. Then if you look at the money supply and the monetary aggregates, private sector credit, all that is actually a little bit lower than we would like it to be. And interest rates are higher, particularly real interest rates are higher than we want them to be. So all that points towards loosening monetary policy. The only caution, and also the international environment, global central banks are easing monetary policy. So that also makes it easier for us to have a relaxed attitude to monetary policy, because there isn't this pressure of interest rates going up and attracting capital out as far as the global economy is concerned. So all this makes us, take a stance, a relaxed monetary policy stance. Only thing we're watching is the government's budget. If the budget deficit increases sharply in the lead up to elections, then the central bank or the Monetary Board has to lean against that and raise interest rates. So we're watching to see what happens to fiscal policy. But other than that, we'll be kind of relaxing monetary policy. So if you look at all these indicators, the economy seems to be in a good place. The one thing is growth. We projected 4% growth. Now, after these events, we are saying 3.1. But even 4% is not sufficient. We need to get 5 and 6% growth. But that has to come through structural reforms of the economy. The central bank can. Actually, we can create a sugar high. We can pump money into the system and push growth up, but inflation will go up because we are putting excess money into the system. So the supply of goods and services doesn't change, but the supply of money changes. So the price of goods and services go up. Equally, some of that excess demand that we create will leak into imports, and that will put pressure on the balance of payments and also pressure on the currency. Another thing that can happen if we just pump money in is asset bubbles. That, for instance, the share market, or now at the moment the share market is right down, but you can create asset bubbles in the property and share market. So, central bank just creating a sugar high cannot be sustained.
Exactly the best thing to do.
No, you can get high growth for 1 year, maybe a year and a half, 2, but then you will have a crisis. So clearly either a balance of payment crisis or inflation getting out of hand, or both. So what you have to do is really to get good quality growth by improving the business climate, by having reforms in the land, labor and capital, the factor markets, by better investment promotion, create the right environment for both domestic and foreign investors, Those are the kind of things that you have to do. You know, trade policy, trade facilitation. These are all reforms that the government has started, and we have to press through with those.
Right. One thing I was very curious about is now after this problem, a lot of people are suffering because of their loans, and they have been appealing to banks. They have not really responded, and even credit card lending rates have, after you took off the limit that for the interest, it has actually gone up where competitively it should have come down. Now, because private borrowing like this for people is at, I would say, even a record high because the number of cards they are pushing and all this, and along with the other problems, what is the, how does it affect the economy as a whole? Because if all the people are borrowing to this extent, how can they sustain it?
Well, interestingly, we are just starting a study. We are a little concerned about what the economists call leverage in the economy,
Right.
how much borrowing there is, particularly in the household sector.
Yes.
We have a pretty good idea of the borrowing in the company sector because we can see the exposure to the banking system, and we have studied that. Where we are now beginning to do surveys is on household indebtedness, and the numbers, you know, at a kind of superficial level, intuitively we feel that it is high. What you say is true, but we are trying to understand what the scope of the problem is, and then to see what action can be taken to make sure that it doesn't get out of hand. Now, if you remember the global financial crisis, at that time, so we had governments also had debt, and corporates and households all had debt. That was the problem. The leverage was amplified right through the economies of the advanced countries, which made the problem far more severe. So we also need to make sure that we don't have too much leverage, or in layman's terms, too much borrowing in those different components. The government shouldn't have too much borrowing. We know our government has a lot of borrowing. What about our corporate sector? Corporate sector also has exposure, but not, for instance, India has had very serious problems in terms of corporate debt. Our situation is not quite so bad. In fact, it's okay as things stand. Now we are trying to understand what the leverage, the borrowing in the household sector is.
Now, that is a big part of a main problem. What would the government actually do, or what could be done to ease that or sort of manage that issue?
Well, one thing, of course, is to increase the price of money. I mean, to increase interest rates.
Right.
I mean, the extreme situation is to have credit ceilings,
Right.
which we did in 2012.
Right.
When we had a very severe balance of payments crisis. We wanted to reduce credit, and we put an actual ceiling on
Right.
credit. That is going too far. We don't need that. We're nowhere near that situation. But what you can do is essentially two things. One is moral suasion, clearly. You get the message out to banks, non-bank financial institutions. You can try to improve financial literacy and awareness amongst the population. These are all things one can do in terms of moral suasion. The other thing, of course, is using interest rates as an instrument.
Okay. We will be going in for a short break now. We will be back soon on this program, The Way Forward. Welcome back to The Way Forward. On our show today is Dr. Indrajit Kumaraswamy, Governor of the Central Bank. We have been discussing the economy of this country and the best way it could be taken forward. Welcome back to the show, Doctor. Doctor, now as this country needs actually what I would term a quick fix to get this thing going, what are the best sectors to be developed?
Well, let me say one thing before we actually look at specific sectors. When you have a population of 21 million with purchasing power of per capita income of about a little over 4,000 US dollars, you can't drive growth on a sustained basis by relying more on the domestic market.
Right.
Exports, external demand. Exports have to be a key part of the narrative in terms of driving growth on a medium to long-term basis. So that is where we should put our efforts. Historically, we've had an anti-export bias in our policy mix. Our exchange rate has tended to be overvalued, and whereby we subsidize foreign producers at the expense of our own producers through the exchange rate. We have got effective protection is very high, which tends to take money away from the tradable goods sector to non-tradables, and productivity growth over the last 30 years has been only 1%.
1%.
1% per annum, which is, quite frankly, I would go as far as say appallingly low.
Yes.
So that has been poor. So you see, in a globalized economy, there is a very high premium on competitiveness.
Yes.
So if your productivity growth is so low, and you're a 20 million economy and you are dependent on external demand, exports that is, that is not, that equation does not work. You can't have sustained growth, good quality growth. So we have to create a policy framework first, before we look at the sectors, to promote exports, to have export transformation. So as I said, a competitive exchange rate. We have to take away these para-tariffs that we have. You know, in the modern world, you have these cross-border production sharing networks, these supply chains.
Yes.
Right? The most dynamic component of the international trading system is intra-firm trade in Asia. That is the supply chains of these Asian firms. Now, Japanese firms, Chinese firms, ASEAN firms, etc. Now, so in this modern production sharing network scenario, the distinction between exports and imports gets blurred. You basically bring something in, do your little bit, and send it out. Now, if you put a para-tariff in the middle of that, you become uncompetitive.
Yes.
So we have too many para-tariffs. So we have basically excluded ourselves from the most dynamic component of the international trading system by having these series of para-tariffs. So the exchange rate is a problem. Overall effective protection also militates against producing competitive sectors which can sell abroad, because the protection reduces competition, reduces your capacity to drive costs down and be competitive externally. So now these para-tariffs has taken us out of the most dynamic part of the trading system. So for all these reasons, one can argue that we have had an anti-export bias in our policy framework. So that is being gradually undone. So we don't defend any exchange rate, any particular exchange rate level. We manage it flexibly, but we intervene, the central bank intervenes to stop disorderly adjustment, which is not aligned with the underlying fundamentals. Otherwise, we try to give a competitive exchange rate. At the moment, it's actually undervalued. Then the government has taken away about 1,300 para-tariffs, and it's planning to remove more over a 5-year period. Because the problem, you can't take it all away because that is revenue for the government.
Right.
So when you take these up, so you make it, it's more export friendly, but the government revenue takes a hit, and that's a big problem. So you have to do it in a balanced way. But we are moving in the right direction. Plus, they've got now, the government has an export strategy it has put out, a national export strategy. Within that, they put out a trade policy framework, which sets out the overall trade policy. Below that, they have the national export strategy. And there is also work being done on a strategy for innovation and entrepreneurialism. So these are kind of the overall strategic work that's being done. And they have tried to provide a level playing field for local industry through this trade adjustment package, which has now resulted in the setting up of a trade and competitiveness commission, which will look to see how domestic industry needs to be supported. As the economy is liberalized and effective protection is removed to drive competitiveness and increase in productivity. As that happens, you have to provide a level playing field. So this trade and competitive Commission is supposed to look at those issues, see what support is needed for local industry. Plus, the Anti-Dumping and Countervailing Duty Act also provides us with an architecture to ensure that there is a level playing field, so that people can't compete unfairly against our local producers. In addition, you're getting this on trade facilitation. There's a single electronic window customs are now putting in place,
Right.
and a trade information portal the Department of Commerce has now put out. So all these things are now coming into place. Plus, of course, we are negotiating these trade agreements. We've got this FTA in goods with India and Pakistan. The Indian one we are trying to broaden and widen to include services, investment, technology, training. We have a similar agreement already with Singapore. We are trying to have a comprehensive partnership agreement with China as well. The interesting thing is, if we are successful in completing these negotiations and we are able to complete an agreement with China, we would be the only country in the world with preferential access to China, India and Europe under GSP+. That's a USP, a real unique selling point.
Right,
190 countries are chasing foreign direct investment.
Right.
Nobody else would be able to say, if we are able to complete this agreement, that they have preferential access to these three massive markets.
No.
And on top of that, we have the location. We are just 20
Yes,
miles
yeah.
from India, smack bang in the middle of China's maritime Silk Route. So, access to ASEAN, access to the Middle East,
We
our
are right
location is absolutely
Perfect.
perfect, which we need to leverage. And we have good international relations with everybody. And we need to leverage that as well. With the geopolitics of the Indian Ocean region are such now that there's renewed interest in Sri Lanka on the part of major countries.
Yes.
We should see that as an opportunity.
That's an opportunity.
Exactly.
Because now, isn't there some talk about that in a more negative manner in the press now?
Well, you...
Especially the agreements
yeah.
and all that, there are cautions and things like that.
Now, as far as the agreements are concerned, we have to negotiate them very rigorously.
Yes.
Do a cost-benefit analysis. Do it all extremely rigorously. See what our national interests are. Pursue them rigorously. However, not to have agreements when the rest of the world, the multilateral negotiations under the under the Doha round have reached an impasse. They're not going to go forward. And certainly not at the moment under the US position on the WTO. So everybody is signing trade agreements. I think Vietnam has 20.
Okay.
Now,
20.
if everybody else is signing trade agreements and creating market opportunities, and we don't do so, and we are a 20 million country who has to export if we are to keep increasing our growth rate, or at least have a high enough growth rate to meet the aspirations of our people. We know from history that when growth gets stalled and the aspirations of our people are not met and there's a mismatch between opportunities and expectations, there is trouble.
Yes.
We've had 2 JVP insurrections, we've had a separatist war in the north. I mean, there's complex causality behind all those events, but this mismatch between opportunities and expectations is one major cause. And so we should learn lessons. We need a relatively high growth rate to meet the aspirations of our people, and we need to be able to export and meet, and to have external demand for our goods and services to achieve that. And these market access agreements can help, provided they are negotiated well, provided also now that we have got an architecture in terms of the Anti-Dumping and Safeguards Act, in terms of the Trade and Competitiveness Commission. So, we have put in place an architecture to make sure that we benefit from these agreements. So we shouldn't be scared, But Sri Lankans all over the world do extremely well. I mean, so
yes, of course, there is no
we can
question
compete.
about that.
We can compete. There is
Because
no issue.
what I would see is actually, like you said, it's basically a lack of opportunity for the people here, which is why they go out and then they are fantastic over there. someone who couldn't work here becomes the best employee in another country.
But if you give them the right opportunity, you know.
All the productivity can
Yeah.
come here. Dr. Finally, I would like to ask now what you are saying is now the network and the architecture, all that is now being pushed into place. What would you say if, in ideal situation, if these things start working as they should, how many years would it be needed to make a noticeable change?
I think, you know, you can have a noticeable change in a year or two. I didn't answer your question about what are the low-hanging fruit in terms of growth.
Yes.
Tourism is clearly one. There are 6 export areas that the National Export Strategy has identified. Outside tourism, I think there, let's see whether I can remember them, there is ICT, BPO, there is wellness tourism, there is, I said outside tourism, but they have identified wellness tourism, there is boat building, there is, what do you call it, these spices and concentrates, there is electronic and electrical goods, and there is one more. There are 6 areas that they, EDB has identified as potential growth areas. So in addition to that, some people say our wages are too high for manufacturing. I don't agree. Definitely, for instance, the Chinese are willing to develop an industrial zone around Hambantota. For the port to be profitable, and now they have a large share in the port,
Yes.
you have to develop the hinterland and have capacity to export and to earn foreign exchange, to pay,
Yes.
to have a decent return on their investment. So if we are, the problem as I understand it is that we are slow in creating the environment for them to come and invest. Equally Port City, that could be another major source of growth and development. But now I see the land has been vested in the UDA, so they can now start marketing and selling it. There's going to be a financial center in the middle of it. So that will be another source of foreign exchange and growth and development, and also higher. See, what we want is not just low-level employment, but higher-level employment, which gives a decent return.
A higher quality on everything.
Yeah, yeah. So the other area is, of course, logistics, shipping and logistics.
Yes.
I mean, Colombo Port is doing exceedingly well, as you know, and now there's another terminal they're going to build, the East Terminal. So there are all these opportunities, and as I said, with our location, with our international relations, and our human resources, I mean, our basic education is good. In terms of access to formal education, we overachieve. But the learning outcomes, particularly in some of the key subjects, the STEM subjects as they call it, science, technology, engineering, maths, plus an international language, ideally English, because that is what is most widely used. So we have, so essentially I see 3 things, right, if you want to go fast. One is you have to have macroeconomic stability.
Yes.
And there we are putting into place 4 frameworks. We are having a flexible inflation targeting framework, which is a forward-looking, data-driven monetary policy formulation. And we are trying to institutionalize it in a new Monetary Law Act. Then the exchange rate becomes the first line of defense under a flexible inflation targeting regime, so you have to manage it flexibly. So we have a clear framework for that. Then the government has a Fiscal Management Responsibility Act, which has certain targets, but every year the targets are missed. Now the Cabinet has approved to have some fiscal rules to give teeth to the Fiscal Management Responsibility Act. So again, a framework is being created and it's being institutionalized in law. And on debt, which is the most vulnerable aspect of our economic management, we have now got the Active Liability Management Act, which enables the government to instruct the central bank to raise money purely for debt repayment. Historically, the government could only borrow what it required under the Appropriation Act. So you had expenditure, you had revenue, and the gap, there was an amount, and that was the amount the government could borrow. But for its use in any given year under the Appropriation Act. Now, under this Active Liability Management Act, which was passed last year, you can raise additional money over and above the government's requirement under the Appropriation Act, and that money would be used only for debt repayment. The money would be raised and placed in ring-fenced accounts, and as I said, the money would be earmarked for
So
debt
will
repayment.
that give relief to the rest of the, because then it won't be a take off from the other income?
Well, it will be, no, in a sense, it will be additional.
Yeah, it additional cost, yes.
Yes.
But
But
it should also benefit in some way.
Yeah, because it gives you greater clarity.
Yes.
It will reduce our refinancing rollover risk, because we will go into the market opportunistically, collect money and keep it so that we can manage future payments in a more predictable way. And side by side with that, the central bank and the treasury and the central bank have developed a medium-term debt management strategy. So we have a medium-term strategy. We have now this Active Liability Management Act, which enables us to raise money just for liability, for debt repayment. The two together, I think, now puts us in a good position to manage the debt. But I must point out that all this assumes that the government's medium-term fiscal consolidation strategy remains on track. If it remains on track, we now have a plan and we have the architecture to manage it. But if the government loses control of the fiscal consolidation, then all bets are off, and we have very little room to maneuver. I must tell you that. We have very, very little room to maneuver. So, discipline, then we can create a good foundation to build along the lines we have talked about. We mess it up and we let the fiscal discipline go, then things can become very bad.
So, thank you, Doctor. That gives us a very, very clear indication of what it is, and I think you very eloquently told our viewers of the picture of what is out there actually to see, because there's a lot of misconception about all these free trade agreements signed and what it's going to do, and there's a lot of doomsday stories. So I will thank you once again for being on our show. You were very enlightening.
Well, I hope it's helpful.
And we will hope to see you again on another show, perhaps on another panel, because you have a lot to contribute to us.
I don't know
Thank
about
you.
that. I should just end up by saying that I would urge people to keep looking at the facts, look at the data.
Right.
We must take emotion out of economic policy making. It has to be data driven, it has to be evidence based, and let's make good decisions.
I think that's a quote I would use one day. Thank you.
Okay.
That brings us to our show of The Way Forward. We had Dr. Indrajit Kumaraswamy and we discussed the economy of the country. And of course, The Way Forward was very clearly and eloquently presented by him. We have, I think, by now the whole situation has been put into place. All we have to do is hope for the best and hold on to what is stable and carry it forward.